Hey guys, this is Mike Agnew, CTA Manager at Magna Libra Capital Advisors, and welcome to another Economotion Capital Trading Group weekly update for August 6, 2019. As you can see here on the left side, that's the Economotions blog site. Go there, www.economotions.com, and on the right side you can see the Futures and Brokerage Services front page of capitaltradinggroup.com. The title of this week's update, the Fed's message is unclear. As always, we got to post our confidentiality and risk disclosure document as we are an NFA registered CTA Magna Libra. The key to unlocking your portfolio's potential. All right, let's get into it, guys. FOMC cut last week, Fed funds by 25 basis points. Powell was a dud, as you saw in his meeting. If you guys missed it, he was pretty lackluster. His 25 basis cut and his rationale didn't make much sense as he used the old actually not old, the new mid-cycle adjustment term, whatever the heck that means, but the markets didn't like it. Nonetheless, the Federal Reserve lowered their target range from 2% to 2.25% in that range, down from 250 to 225. So a mild 25 basis cut, and the markets weren't happy. As you can see here from the CNBC Twitter, Dow drops more than 200 points as Powell hints rate cut was just an adjustment, not the start of a trend. Yeah, right. As we'll see later on in the slides, global yields are plummeting. Negative and further negative. In the U.S. stock market, no likey. As you can see here, the S&P 500 futures were hit down from this important 30-30 area. Even before the announcement, you could tell that they were a little bit under pressure and weren't going anywhere, and then they obviously tanked here as this chart shows. 2783, 2775 is the first support of the 50-period VWAP, and as we'll show you, this chart was from the August 5th. You can see what happened as over the course of the next day or so. Underneath that, though, guys, we got the 38.2 at 2757, 2760 area, and that should provide some fib support there. Trump's rhetoric was, as usual, pretty harsh upon the Fed as well as Powell, and to quote him here, as usual, Powell lets us down. As we all know, Trump's been pretty harsh onto the Federal Reserve, even though we're supposed to be non-politically motivated. But as you know, Trump wants lower and lower rates to keep the economy going, and 25 basis points just isn't going to cut it, as his tweets are very obvious here of a letdown that Powell gave the markets. Obvious blame right on the Fed. Also after that, this week, Trump paced China as a currency manipulator, and to quote him here, China uses currency manipulation to steal. Pretty bold language out of the Trump administration, and something that we figured that they would probably consider them a manipulator, but we didn't think it would happen this quickly considering the tariffs and the fight that's going on. And China's going to try to fight these tariffs with the devaluation, and we all know that can't happen. They've got a limited capital base, and if they try to do that, then you'll see a huge capital flight out of domestic China, and obviously Bitcoin will be a good recipient of that, as we've seen in the past. But we feel that this is a battle that China cannot win, and Trump knows this, and he always negotiates from the position of power. As far as the Fed, they're trying to play catch up. As you can see, global rates here, all negative and getting more negative. And, the Fed, hands just being forced as these global yields enact what we like to say is a stealth tax and a bail-in, because when you're paying somebody to hold your money, that's a tax, plain and simple. And as you can see, the U.S., if you look down bottom right-hand corner of this negative bond yield matrix from @CharlieBolello, we like to post some of his stuff, and you guys should follow him if you don't, because he posts some really good stuff and has some key unique insights. But the U.S. is just playing catch-up, and the equilibrium of the zero bound has been broken, and you can expect the U.S. to go where all these other rates are going, unfortunately. They've broken that zero bound equilibrium, and thus the all interest rates will be following that path as debt levels grow increasingly higher and exponentially faster. As we can see here, negative yielding bonds reach $15 trillion, and as the yields breach the zero and go negative, this drags the entire, as we talked about, leverage finance system into a new paradigm, or what we like to say, welcome to the upside down, for you Stranger Things folks. So what happened in the bond land after the FOMC? You can see the 30-year bonds exploded, eyeing that all-important 2% level. These are the futures here, September futures, and you can see the 159.10 level was broken through here on the right side of the chart, getting up to the 618 at 160, a little bit over 160.01. I think that's up there around like 160.10, 12 area. and that's going to provide some fib resistance there. But ultimately, expect the bond to reach up to that 786, whatever, that's when the stocks really fall. That we expect that to get hit, but expect a little resistance up here in the 160, 161 area in the U.S. 30-year bond. So let's just keep an eye on that one there. So look at this chart from once again Charlie Bolillo. Remember, the equity market outperformed bonds, or does it? The TLT Long Duration Bond Fund tops the S&P 500 for 2019. The TLT is up 15.7% year to date compared to the S&P, the SPY ETF, which is only up 14.8. As you can see on the bottom half of the chart, the U.S. Treasury yields plummeting. So for all those arguments that bonds are a bad investment and stocks always outperform, not so much. And even getting a further over time, surely the S&P 500 outperforms over time, right? Well, once again, no. The Vanguard Long-Term Bond Index Fund is up 319% over the 20-year total returns, and the Vanguard S&P 500 Index is up 211%. So take those charts to your local equity advisor and tell them, what do you mean we should outperform bonds all the time? Good luck. And you can see here Apple falling in terms of their cash versus Google. And this chart should, as we entitled, be very telling for the future. One trajectory is down, the other is up. And we expect these tech titans to be underneath the microscope of the government's antitrust in the coming years, because they're just becoming too powerful. And although Apple's cash is less debt is dipping down here, they still have a formidable war chest, no doubt. And Google still is on the rise here, so gaining more cash as time moves on. And finally, let's go to some Bitcoin charts. We thought these were pretty interesting. Guy here on Twitter at 100 trillion USD put up some nice graphics here. On the left hand side, you see the BTC, which is the Bitcoin symbol that we like to use, the bull market's timing. And as the number of blocks in its difficulty bottom, the price divided by that, you can see here on the blue dots, that's usually where the Bitcoin bull markets start. And then obviously the hash rates blocks get tougher and tougher to mine, and then the top sets in. And on the right-hand side, you've got what we technicians always like to watch too in the longer term, the 200-week moving average. And Bitcoin, you can see how it bounced there in mid-2015, and then it bounced there again the bottom end of 2018 and going to 2019, and we're seeing the up move again. So that 200-week moving average comes right in around $4,000 per Bitcoin. So keep an eye on that, guys. I'd like to always throw some Bitcoin stuff in here when it's starting to move, and then we're big believers in blockchain and going forward in the P2P network and everything that it has to offer. So that's it. Just a quick update. Keep an eye on the markets. Stock markets did bounce today quite a bit on no news, of course. Although I think Kudlow was out saying some stuff about China again and maybe easing back here some of the rhetoric and maybe some working together instead of trying to fight each other on all these issues. So we'll see. But we don't ever believe any of the words that come out of these politicians' mouth. It's just we like to look at the markets, the price will tell us what's going on. So that's it. Bonds are up a little bit as we speak, and the equity markets are turning back down a little bit again. So we expect that the equities aren't out of the water yet. We know that these negative interest rates in the yield falling are going to eventually catch up with the U.S. equity markets and global equity markets and drag them lower. Just a matter of when, not if. So keep an eye on that, guys, and we'll be back next week. You want to look into us further here, you can see, you can find our blog post, like we said, economotions.com. Find out more about Magna Libra at magnalibra.com, and you can find out more about Capital Trading Group at capitaltradinggroup.com. And as always, I'd like to end it with Magna Libra doesn't want to make up the majority of your portfolio, but rather we want to be a significant portion of your alternative investment allocation. All right, guys, that's it. We'll talk to you next week. Good luck.